Hi folks, welcome back to the second part of our recording where we will finish off making our journal entries. Now where we left off last time in the first video is we left off on transaction 9. We completed that. But now in transaction 10, they told us for AJ Smith that the company had paid operating expenses in cash. So what does that mean? That means your cost of doing business went up, so an expense goes up. And of course, we know that when an expense goes up, so if we looked here, we saw our expenses are going up. They go up on the left, and left means debit. So therefore, we're going to debit our expenses for $50,000 and credit cash because we're paying in cash. And when cash goes down, that cash is an asset. So when an asset goes down, it goes down on the right, and right means credit. So again, we've now got our asset going down. So all we'll have to do there is to credit it. So again, you'll see that the total dollar value of all the debits and the credits processed in this transaction is equal. Now we get into what I would call an adjusting entry. We saw an example of an adjustment up here, right? But the text didn't identify this, but we normally include it as part of our adjustments. Why? Because you'll see that most adjusting entries are those that we make at the end of a period, and in this case we're recording depreciation over the year that we've had the building. You'll also see that we've introduced you to a new account. The new account is accumulated depreciation on the building. So let's walk through this transaction and see if we can't figure out what the accounts mean and just review how we got the amount. So in this particular case, the question told us that the building that was purchased earlier was being depreciated on a straight line basis. And remember, the whole point of depreciation is to take the net cost, which is what we set it up at in transaction 2, which was cost, less what we think we'll get for it at the end of 20 years when we abandon it or sell it. Right? So this net amount of the cost, which is 142.5, we're going to allocate that over 20 years. Why are we doing this? Because depreciation represents an allocation of the cost of a depreciable capital asset. So all we're doing is allocating the cost of the building over the period that we have it, because those are the periods that the company will benefit from its use. So these buildings, maybe equipment, whatever we're buying that we depreciate, presumably we're buying it because it's going to be useful in helping us generate revenue in the company. So because we're buying these depreciable capital assets to help us generate revenue, we have to have a cost of generating that revenue, and that cost for the asset is depreciation. Now you might say, well, cost is 172.5 less 30,000, so we already know our cost. Yes, but you have to allocate it over the period that you expect to use that asset to help you generate that revenue, and the question will give that to you. In our case, it's 20 years. So we get 71.25. Now that's a cost of doing business, so we're going to debit depreciation expense, and unlike any other expense, it's increasing. When it increases, we increase it on the left, and left means debit. Now, instead of crediting the building account directly, your text introduces you to a new account, which is accumulated depreciation. So in this case, all we do is we set up what we call a Contra Asset account. Sometimes I refer to them as XA. I don't know if the textbook does, but sometimes when I'm teaching in the classroom, I do X means contra, A means asset, just so the student remembers. And a Contra Asset is an asset that has a balance that's contra or opposite to other assets. So for example, when an asset goes up, it goes up on the left, and left means debit. In this case, the contra assets will go up on the right, and right means credit. So they're opposite or contra, all right? And this is a contra account to the building account. So what we try and do is we try and, on the balance sheet or statement of financial position, preserve the asset at its original cost, which is 172.5, and then show the accumulated depreciation as a contra account to that on the statement of financial position. So we have that to be 71.25. So as long as you remember anything that says accumulated depreciation, it's a contra asset. And by contra, we mean its balance is opposite to other assets, so it behaves differently. So this helps us when we use this account in the statement of financial position. It helps us to state our asset at what we call the carrying value. All right, so we'll show you that when we get into the adjusted trial balance as well, where it shows up. Now we're going to do the same kind of thing for our equipment account. Remember earlier we bought equipment for $120,000. We thought that at the end of 10 years we could get rid of it for $5,000, and we are going to have it for 10 years. The only difference here is that now we're allocating any depreciation over the period of time in the current year that we had this equipment. We didn't buy this equipment till July the 1st. See, the building over here, we purchased that building January 1st, so we've had it the whole year, so we don't need to multiply it by any fraction. But here we've only had it for 6 months of 12, or a half a year. So we're going to multiply it by 6 over 12 or a half to get 57.50 for our depreciation expense and accumulated depreciation. Again, you'll remember that in transaction 13, we said that we declared dividends of $20,000. However, we only paid out 15. So you remember in the transaction analysis, we had set up a liability of 5,000. So now what's going to happen is your dividends declared are going up. And when dividends declared, we didn't show it here, but when dividends declared go up, what's going to happen? When dividends declared go up, they kind of behave like an expense. But remember we said earlier, your shareholders and any dividend you declare to them is not a cost of running your business. They finance your business, right? So the idea is it does behave the same as an expense, given that when the dividends declared increase, they increase on the left, and left means debit. So therefore, what we're going to do is we are going to debit the dividends declared, credit cash because we're paying out cash, and credit or increase our liability by 5,000. And again, you'll see the total dollar value of all the debits processed is equal to the credits processed in each and every transaction. So now the next step asked us to post them to the T accounts. This is a very important process. The reason being is it's in this process that you get to see what the ending balances are in the accounts. So don't forget, not all questions will ask you to start off doing transaction analysis. That was chapter 2. We don't get you to do any more after chapter 2. Transaction analysis was there to help you get used to naming accounts and identifying them and knowing if they're increasing or decreasing. But in the real world, accountants have already analyzed it in their heads, and all they're doing is making the journal entries. So once we make the entries, we have to now post the entries to these T accounts, or what we're using is T accounts to kind of simulate the ledger accounts, the accounts that the company would have. So now notice that we set up one account for cash. So sometimes what I find with students is they'll say, well, okay, I had cash impacted here and cash impacted here, and they set up 2 different cash accounts, and then a third, and then a fourth. Cash is one account. What you're trying to do is you're trying to see or summarize all of the activity that happened over all of these transactions. How did they affect cash? One account, but maybe several debits or credits to that account. So in our case, all we're going to do is we're going to go back to the entries and say we debited cash, we credited cash, we debited cash. So we're going to look for all the transactions where we debited and credited cash, right? And what we normally do is we number them. Numbering them helps us to remember where we got the debit and the credit, where we got the T account amount for, which debit or credit entry. So you'll notice here we start off with 0. So with a balance sheet account, you'd always start off with the opening balance. And because AJ Smith just started business this year, its opening balance for all of its balance sheet accounts was 0. But you'll notice in transaction 1, that's when we increased cash because we issued the shares. In transaction 2, we paid out $80,000 in cash because we were buying land and building. So you'll see all you're doing here is summarizing all of the activity in that account, and you're linking it back to the actual entry number that you gave earlier on when you did the entry. So now you're going to net out all of these credits here on this side, all the credits here from all of the debits. So when you put that in your calculator, you get 170,000. Right? You do the same for all of the balance sheet accounts, accounts receivable, inventory, land. There was only one adjustment to land. And notice here, instead of crediting the building for your 7125, we now set up our accumulated depreciation account for the building, and we do the same for our equipment. All right. Notice here, even for accounts payable, now that we've done the assets, we look at the liabilities, of which we have 5. We have accounts payable, notes payable, interest payable, unearned revenue, and last, dividends payable, right? So then we have our assets, our liabilities, our equity accounts, of which we have 2, and then we will have our 3 if you include dividends declared, and then we'll have our revenues and expenses. And in our case, we have sales revenue of 300,000, right? And we have rent revenue of 22.5. We had cost of goods sold of 190,000. We had interest expense, remember the accrual of 30,000, and then we had our depreciation expense. And again, note we don't have to separate out depreciation expense, one for building and one for equipment. Now you can if you want to, but it's not necessary. It's only necessary when you're using the accumulated depreciation accounts. You have to do it there, but you don't have to do it when you have the expense accounts. And then of course we had our operating expenses. So what we've done here is we've updated our accounts. We're going to talk now a little bit later in this video about what this CE means. Okay, CE stands for closing entries, but because we're not at the closing process yet, I'm not going to address that yet. But what I want to make sure of is that you get all of the balances in there and all of the expense accounts, right? And the revenue and the revenue accounts, right? Get all your expenses in and all your revenues in, and even your dividends, right? Get all your dividends declared, and don't worry about the CE thing right now. And now you got your sales revenue. Okay, so once you've posted everything to the T account, the question asks you to do an adjusted trial balance. Now notice in the adjusted trial balance, the order is important. You go assets, liabilities, shareholders' equity, revenue, and expense. That's the listing. So we've got all of our assets, and notice in order of liquidity. Remember we talked about liquidity in our chapter 2 video. Liquidity refers to how easily convertible any of the assets are to cash, and there's nothing more convertible to cash than cash because it already is. And accounts receivable, inventory, land, buildings, and notice right underneath buildings we have accumulated depreciation, right? So again, normally these accumulated accounts are buddied up with the account to which they're contra to. So this is a contra account, so it has a credit balance when it goes up. Okay, and even accumulated depreciation for equipment, same thing. It's a contra asset account, so its balance goes up on the right, and right means credit. But don't forget, it's still an asset account, but it's a specific type. It's a contra asset account. All right, so now notice in the adjusted trial balance, all we're doing is we are listing from the T accounts that we had up here, from the T accounts, all of the ending balances in our accounts, all of the ending balances, right, that we have here. Notice that for here, what they did is they posted the closing entries, and we'll get to that in a minute, to bring it to 0. I only want you to go to here. Remember I said don't worry about the closings for now. We'll get to that. But you have to do the adjusted trial balance first. The adjusted trial balance is the document you use to actually help you prepare the statements. So once it's adjusted, meaning that you've got all your adjusting entries, of which we had 3 in our question, one to set up our interest expense and interest payable on the note payable. We had another one to record depreciation expense in the building, and another one to record depreciation expense on the equipment. So that means we've got all of those non-cash adjustments in there, and so all we're doing is listing the account balances before we close. So the adjusted trial balance is always done before you close out the income statement or statement of earnings accounts and dividends declared. We got to do the adjusted trial balance first. So that's done before closing. So now what we're going to do is we're going to take those balances that we've got, and we see that our total dollar value of all the debits in the accounts and all the credit balances of all the credit balances and credit accounts are equal. All right. So now, normally we would go ahead and now do the statements, but I'm not going to do them because we did them as part of the problem in Chapter 2. So you can go back now to all of your financial statements, and if you went back, say for example, to your income statement that you did, you would find these accounts listed in the income statement. If you went back to your balance sheet, you may not see accumulated depreciation, but you'd see it at net at 172.5 less 71.25. You'd see them at net, right? So you'd see a balance for notes payable, interest payable, unearned revenue in your liabilities section, so they would all be listed. So I'm encouraging you at this point to go back and look at the problem that we did for Chapter 2 to make sure that you can see where all of these balances tie back to the financial statement, specifically the statement of income or statement of earnings and your balance sheet or statement of financial position. If you look at those two, you should find these balances in there somewhere. You'll find this one at net, this less this, and you should see your equipment at net. Okay, so now that we've got that, now we say, once we've done the statements, we would say, well, now what we got to do, once we've done our income statement, once we've got the adjusted trial balance, we've done our income statement using the information on that, now we got to close the income statement accounts. What do we mean by closing? What we mean by closing is we need to, and I'll just type it in here, we need to update, or we need to bring the income statement or statement of earnings, whatever you want to call it, or statement of income, they all mean the same thing, to bring the income statement, accounts, and dividends declared account to 0 in order to accept new numbers or new amounts in the next period, right? So all we're doing here is we're saying, well, look, if we need to collect income figures for the next year, 2017, I don't want to have old income figures in there. So I don't want my old profit in there. Profit, don't forget, when you did the income statement or statement of income, we did it over a period of time. It was for a year. So I don't want net income or profit from 2016 in 2017. So I got a 0 amount. So what do? I use my helper account, and they introduced you in the chapter to a helper account called income summary. Income summary is not an account that you will see on any financial statement. It's what I call a helper account. It's there when you need it to close. And I also refer to it as an agnostic account. It has no normal balance. It's neither a normal debit nor is it a normal credit balance. It's just used to facilitate the closing process. So once I've got my income statement done, now I want to zero out all my revenue accounts. And I had two. I had sales revenue and rent revenue. Right? So if I go up here, I've got my sales revenue and my rent revenue right in here, right? So now all I want to do is zero them out. Well, I know they're normal credit balance accounts, so to zero them out, I got to debit them, and I'm going to use my helper account and credit 322.5, which is the total. And now I'm going to use my income summary account to close out all of the expense accounts that are on my statement of income or my income statement, right? So now what are those? Those are normal debit balances. We've already said that. You've already seen a video from the course author or textbook writer, right? He talked about normal balances. So our normal balances for expense accounts are debits. So in order to zero them out, I got to do the opposite, to credit them, to zero them out. And then I'm going to debit my little agnostic account here, income summary. Right? So now if I go back, notice that we set up a T account here for the income summary, way back up here. And we said we credited the income summary when we closed out our revenues, and we debited the income summary, okay, when we closed out our expenses, right? So we can see that here. If we go down here, right? Right here. So these we see in the income summary account. But now, what's the net balance in the income summary account? Well, if I look here and here, it's a net credit, right? It's a net credit of $66,625. So now that it's done its job, I don't need it anymore. So I'm kind of using it, right? So I'm saying I'm just using this account to help me close out the revenues and expenses. So now it's sitting with a balance at net, because the right side is bigger than the left side, and right means credit, it's sitting with a net credit balance of $66,625. Well, I want to zero it out because I don't need it anymore. So I'm going to debit it. And where does all that profit go to? All the profit, the $66,625, goes to my retained earnings. So don't forget, whenever you have net income, right? Net income updates retained earnings. So therefore, I'm going to credit or increase my retained earnings, right? So this was actually, you'll remember, the difference between the income summary credit and the debit is the amount of income you recorded. So if you go back to what we did in the Chapter 2 problem where we started this discussion with this data, you'll see that our profit was, or our income was, $66,625 for that question. And that's why we're debiting the income summary. Now we want to close out all that profit that's sitting in income summary and transfer it to retained earnings. And again, that's what our little graphic in the earlier chapters told us in Chapter 1. When we have income, it updates retained earnings. It does this update net income to retained earnings through the closing process. So accountants must close the books in order to update retained earnings with income. It doesn't just magically appear. And then what we do is, don't forget, dividends declared were not part of expenses, right? So we close them out separately. And we also know that dividends declared, if you remember, any dividends that we declare affect your retained earnings. They reduce retained earnings. So our retained earnings at the end is reduced because we've declared dividends. Therefore, what we're going to do is we're going to close out our dividends declared. Don't forget, it was normally a debit balance account, so we're crediting it to close it, and we're going to debit it to retained earnings. So now our retained earnings account has been updated for income and dividends declared. So it went up when we booked income, and it went down when we closed out dividends declared. So it goes up for income and down for dividends declared. So hopefully that concept's a little bit clearer for you. All right. And that concludes our closing entries. All right, so hopefully you found this little video helpful. And if you have any questions, make sure you post them on our discussion boards for the chapter. And have a good day.